Today, household financial confidence balks. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. The latest data from our household surveys to the end of February 2020 shows that the current medical emergency is hitting home. The index dropped again into uncharted territory to an all-time low of 80.2. I even had to change the scale of the chart to accommodate the fall. We asked households to compare their levels of confidence today compared with a year back across a number of dimensions from job security, income, cost of living, debt, savings, and overall net wealth, assets less debts. This gives us a comparative series from the 52,000 households in the rolling sample. Households are reacting to the uncertainty about the future trajectory of the economy, and recent survey results, we run a rolling series to the 5th of March, have captured recent stock market falls. The falls are broad-based, though households with a property remain relatively more positive, believing that property remains largely immune. Well, we'll see about that. Within the property segmentation, property investors are on the mat now as rentals continue to grind down, and property values, especially among units, have not recovered as much as the generic indices might suggest. Households renting are finding more choice and lower rents in a number of centres, Hobart accepted. Supply is quite strong. Most states move lower, with New South Wales and Victoria taking quite a hit this past month. New South Wales hit 84.9, and it's the lowest scored state now, thanks to the higher debt leverage there, where large mortgages predominate. Western Australia, Queensland and South Australia are bunched higher at around 90. Across the age bands, we see falls across the board. The financial pressures on younger households of those between 20 and 30 and 30 to 40 are piling up as they continue to feel the issues most severely. But older households are a little buttressed by share portfolios, which are falling. Prices are down 6% on Monday as we speak, and savings where interest rates are also falling. But all age bands feel the pressure this month. Within the index, we can look at the elements which drive the scores. Job security slid 1.66% compared with last month, with just 4.3% saying they feel more secure than a year ago. 38% feel less secure, an increase of 1.1% from last month, and 47% feel about the same. The full potential impact on jobs has yet to be absorbed by the community, but around 3 million are working in gig-type flexible roles, and others will be encouraged to take leave to try to stem cash flow issues among businesses. Households are taking a beating on savings at the bank, with rate cuts eroding returns to the point that many households are not getting enough income to cover the basics. And the stock market is off and falling as I speak, with the supply side shock of the virus now translating to a potential liquidity crisis. Safe havens are hard to find for the fortunate few who have savings. Many, of course, have none and live from pay credit to pay credit. The cost of debt is falling, so many are seeking to refinance again to grab the lowest rates available to some. However, only 4.2% are more comfortable with their level of debt compared with a year back, and of course if incomes fall as employment falls, paying the mortgage becomes a nightmare. 42.5% are less comfortable than a year ago. And those who recently attained new mortgage finance appear to be in for the biggest shock, thanks to looser underwriting standards of late. Pressures on incomes remain centre stage, with just 1.7% of households saying their real incomes have risen in the past year. More than half of households have seen their incomes fall in real terms over this period, and 40% see no change. Incomes will evaporate for many should the supply-side shocks continue. Costs of living, on the other hand, continue to bite, with more than 95% of households reporting rising costs over the past year. 5% reported no change. Almost no households reported they had fallen. Categories of costs which have been impacted include the usual suspects from energy, fuel, childcare and healthcare costs plus school fees, and also council rates. But the most insidious are those relating to everyday expenses at the supermarket, where drought-related hikes abound. The falling exchange rate is also hitting some imports and making them more expensive. Around 25% of households have less than 1 month's cash available to meet their commitments if their income seizes up. Yet, overall, the net worth of households improved slightly, with property values high in a number of locations, though the recent stock market falls are dragging wealth down for some. The big strategic question now is whether the government understands the true significance of what is happening. Whilst they're talking about a $10 billion package, it appears to be shaping towards investment allowances and other tactical measures. In fact, the level of confidence we're recording in our surveys suggests that households will not be able to spend, consumption being a significant share of the economy, and many small businesses will struggle to employ, yet alone survive. The quantum that they are discussing is too little, too late. I expect confidence to erode even more as things play out and the true horror and economic predicament that we're in hits home, and then the following financial crisis will also strike. I'm Martin North from Digital Finance Analytics. Many thanks for watching. I'll see you again next time.